This one isn't so obvious because sometimes it can be hard to understand how interest rates can affect inflation, but the easiest way to understand this is just by looking at what happened over the last couple of years. When interest rates go down, it makes borrowing money more attractive because, well, it's cheaper to borrow money. So when interest rates fall, more people are going to want to go to the bank, get a loan, and go out and buy a home. So if it's more enticing to people to go out and borrow money to buy a home, well, then more people are going to do that, which creates more demand for homes, and more demand pushes home prices up. Now, the interesting thing here is when this money gets lent out by banks, banks don't have a big vault of cash sitting somewhere. So what happens? Well, when you go to the bank to get a loan, money has to be printed. The bank works with the Federal Reserve Bank, and they have something called fractional reserve lending. It's a fractional reserve system where now the bank will print money, or the Fed will print money, they'll give it to the bank, and then the bank will give it to you. This is how inflation is caused. It's not just the demand, it's when you go to the bank, you go out and you get a mortgage, well, now more money gets printed, and now you have more dollars to go out and buy a home. So when interest rates fall, more dollars enter our economic circulation, and this pushes asset prices up. Now, I just talked about home prices, but you see the same thing happen in the stock market and really every other asset class, because corporations can borrow more money, institutions can borrow more money, investors can borrow more money, and now you can borrow more money at lower rates. So you're going to borrow more money, more dollars enter our economic circulation, and this pushes asset prices up. Now, the Fed is doing the opposite. They are raising interest rates across the board, and we're seeing a number of interest rates hike. And we can expect a number of interest rate hikes in 2022 and probably 2023 as well, unless the Fed changes their course. Essentially, the Fed is still hinting at the fact that the reason why they're willing to raise interest rates and do this type of monetary tightening is because our economy is still strong, because we're not in a recession. And so if we do fall into an official recession, well, then there's a chance that the Fed could reverse their policies. But again, there's no way to predict what the Fed is going to do. We can say what the Fed should do, but that's not always what the Fed does do. So that's why the Fed could potentially change their policies. But again, I really have no idea what the Fed is going to do. So today, if we're in an economic environment where interest rates are going up, this reduces the amount of dollars in circulation because, well, less money gets printed and less people will borrow money and less money flows into assets. That does affect asset prices. I mean, the easiest way to see this is just looking at the volatility that we've been seeing in the stock market, especially the tech sector. Because this tech sector, the startup sector, this momentum sector, these companies for the last number of years have been running in a deficit, meaning that many of these companies have not been profitable because there's been no need to be profitable. Lots of dollars were just in excess. So if you were a company, if you were holding a profit, that was a detriment because that means you had cash in the bank that you weren't using because cash is a liability to these companies. So if you had $10 million in the bank, no investor would like that because they would say, why don't you take the $10 million and invest it in advertising, and then why don't you go out and take out another $10 million loan and hire more people, get more staff, open up more offices, and grow bigger? Because everybody in this tech sector and the startup sector is looking for scale, is looking for growth as quick as possible. So these companies are not holding on to cash, and now that interest rates are going up, people don't have that same mindset of, well, forget about profitability and just grow as quick as you can. Now it's switching. But people want to see profitability. They want to see companies being sustainable. And now if you're a company that can't hit profitability, you're going to get hit hard. The Federal Reserve Bank put out a press release talking about how they want to reduce the size of their $9 trillion balance sheet. Now, what I want to explain first is how this works, and then second, what the Fed wants to do. So the Federal Reserve Bank is known as the Federal Reserve Bank, but the interesting thing about the Federal Reserve Bank is that, one, they're not federal. It even says so on their website. They're not a reserve because they don't keep cash reserves anywhere, and they're not a bank because, well, you and I can't go there to bank. So the Federal Reserve Bank is this entity that helps control our monetary supply. And one of the things that they do is that they provide liquidity to the government. Now the question is, what does that mean? Well, if the government, the United States government, needs money because they want to do whatever, well, then either they're going to have to raise tax dollars or they can go to the Federal Reserve Bank. Now, if you run on a cash-based system, what that means is your income has to be equal to or greater than your expenses. What that would mean for the government is their tax dollars have to be equal to or greater than their expenses because the government gets their money from tax dollars. Now, it's not a surprise that this is not the case because the United States government right now is running like a $30 trillion or so national deficit. What that means is that they've spent $30 million more, sorry, $30 trillion. Did I say 30 million? I am so sorry. $30 trillion more than what they have brought in through taxes. Well, they have to get this money from somewhere because if they just kept raising taxes on everybody, you'd see a lot of unrest because everybody would say, well, I am already struggling to survive. How are you going to keep raising my taxes? So they're not doing that. Instead, they create a silent tax because inflation is known as a silent tax. The way that it works is the government calls up the Federal Reserve Bank and they say, hey, Fed, we are going to issue bonds, which are loans, and we need somebody to buy them because we don't think that the American people in other countries are going to buy up all of our debt. So we need somebody to issue us these loans. So then the government puts out this thing, this bond, saying that they need to raise $10 trillion or whatever amount that they need. And if people don't have enough money to buy it, which they don't, that's when the Fed comes in and they pick up the slack. So right now, the Fed has a balance sheet of around $9 trillion. Now again, the Fed isn't a bank, they don't have reserves, so what do they do if they're going to buy $9 trillion worth of assets? Well, they just print this money out of thin air. So the Fed prints this money out of thin air, and then they go out and they buy these bonds from the government, and now the government gets their trillions of dollars, and then they can go out and spend this money however they want. The Fed was able to help fund the government, and now inflation happens because more dollars get printed, the value of each individual dollar goes down, but the government has their cash to continue running their operations. So how do you fix this? Well, one way is, well, the government can cut their expenses, but the likelihood of that happening doesn't seem very high. So now the alternative is, well, the Fed can start selling off some of these assets because now the Fed has this investment portfolio of $9 trillion worth of assets. Now, a big portion of this are United States government bonds, meaning it's money that they loaned the government. And then the second biggest part is mortgage-backed securities. So these are loans for the housing market. And so Fannie Mae, Freddie Mac, they go and buy loans from banks. Banks issue you a loan, and then the banks don't want to hold the responsibility for the loan. They want to get paid right now. They don't want to be liable for people not paying the loans. So then Fannie Mae come in and then they buy these loans from the banks, then they chop it up and then they'll sell it to investors. And again, if there's not enough investors to buy these loans, either because they're not interested or because it's too risky or because investors don't have money, they'll go over to the Fed and they'll say, hey Fed, we got a couple $1 trillion worth of mortgage-backed securities that nobody wants. You want them? And the Fed will say, sure, I'd love to buy them. The most expensive kind of money that there is free money, because when you print this type of free money and you just inject it into the economy, it can create an inflationary spiral. And this is the issue that we're facing right now, because now it is multiplying and compounding the problem. Because now this money gets injected into the economy and this pushes asset prices up. Now asset prices go up and people feel like they don't have enough money to go out and buy assets, so they need a bigger income. So now if they need a bigger income, they go to the job and the company and they say, hey, I need more money. Then the company will try to pay them more money, and if they're paying them more money, then the company has to earn more money. If a company has to earn more money, they have to raise the price of their products, and if they raise the price of their products, then people will go shopping and say, oh, I don't have enough money to buy this stuff. So now they're going to need more money. So it starts to create this inflationary spiral, and that all starts from this free money. It creates a compounding effect. And now the Fed is trying to combat that by doing the opposite. They want to start selling off these assets. So when they were building up this $9 trillion worth of assets on their balance sheet, they were buying about $120 billion worth of assets every single month. So these are things like treasury bonds and mortgage-backed securities. Now they're finally starting to sell them off. Their plan is to sell off $47.5 billion worth of assets every month and gradually increase that month over month until they hit $95 billion a month, and then they'll hold steady there selling off their assets. So the interesting thing that we want to pay attention to here is, what does this mean for the bond market and for mortgage-backed securities? Because if the Fed is now dumping tens of billions, if not $95 billion worth of assets every single month, there has to be a buyer for them. And if there isn't buyers for them because people are running out of cash because of inflation, because they're scared to invest, because they don't want to invest, then that can impact bond prices, which can also impact the stock market. So now, as the Fed starts selling off these assets as a way to reduce the inflation by getting some of this cash and these assets off of their balance sheet, it has to be absorbed into the market, and this could push asset prices lower. lower if there's not enough buyers out there, because then it creates more supply than there is demand. And this brings me to the third point, which has to do with the supply chain issues, because we're still dealing with supply chain issues. Now, these supply chain issues, many of them were caused because of the inflation, because in 2020 and 2021, we weren't producing anything except money. So people were still able to buy things even though we were in a recession, even though nothing was being produced because manufacturing plants were shut down, companies were shut down, but people were still able to shop and buy whatever they wanted because that's just what the Fed did. They gave money out and people had money to spend. So that created these backlogs, especially in this pandemic, because now people were able to buy things from companies. They didn't care about higher prices. People were able to spend whatever money they wanted. Companies didn't have products to sell. And this created this massive backlog. And now here we are today, and we're still facing the effects of those supply chain issues. And on top of that, China is still facing a number of lockdowns because of this pandemic. And so these things are just making the supply chain issues worse. And then on top of all of that, you have everything going on in Russia and Ukraine, which is not only affecting energy prices, but also food prices, because that part of the world is known as the breadbasket of the world. So we have a lot of different issues affecting the supply chain. And now the government is talking about how they can help improve our supply chain issues today. The presidential administration put out a plan on how to help solve these supply chain issues, and what they said in their plan was that they are creating a supply chain disruptions task force. Essentially what they're saying is that they want to invest more in our American infrastructure and manufacturing. They want to create funds for smaller manufacturing plants that they can lend to and get money from. That way they can invest in our own manufacturing here. They want to create a Buy American plan where the government has to buy products made in America. So they want to start emphasizing products being made in America, which makes sense. I mean, if you want to prevent these type of global supply chain issues, then the best thing to do would be to create your products here within the United States, because then you don't have to worry about things that are going on overseas. You can produce everything here in the United States and you don't have to worry about that. But the downfall is, well, cost. Thank you for watching. If you enjoyed this shorter clip from my longer videos, here's another clip that I think you'll love. And if you're interested in learning more about how to invest your money in the stock market, our team put together an amazing guide that will walk you through how to invest your money in the stock market, what the stock market is, different stock market strategies, and how to build wealth in the stock market. This guide is completely free when you sign up for our daily newsletter. So if you want to read this guide, all you got to do is click that button right over there. Thank you for watching, and as always, keep hustling.